Let's go ahead and it's 3:02. Want to respect everybody's time. Celtics are winning game 8. That's right. That's good. We want to respect everybody's time. So let's go ahead and get started. We wanted to thank everybody for being here. Really appreciate you showing up. And we know this is a very interesting topic. And so we brought our expert. Josh Heinz is on our acquisitions team. He's been with us now over a year and was a part of, I think, probably 20 deals last year or something like that, Josh. So we have him, and then we have the old school guy, Matthew Whitaker, with us. Matthew was a part of some of the early deals, but they don't let him get too involved now. So, but Matthew's our CEO, and glad to have both these guys with us. My name is Spencer Sutton. I am Director of Marketing. And so that's all I do. But I do want to, let me see if I can share my screen here. So we do have a sponsor for this webinar, and we're only going to put this up for a little bit. We just have a few things we want to run through real quick. We do have a sponsor. Peter Lohman is a good friend of ours. He is a property manager out of Columbus, Ohio. He's a fantastic operator, and he has a newsletter. And so he is our sponsor. I'm a subscriber of his newsletter. Would highly recommend it. I know that McKenna's probably going to drop a link in our notes here for you to see. And so we're super thankful to Peter for sponsoring that.
Can I just double click on Peter for a second? I'm really mad about Peter. The reason he's probably not on this call right now is he takes the month of June off every year. So if you want to learn how to be a really good operator, you probably don't need to be listening to us because I'm here every June, but Peter takes June off every month and just uses it as a time to refresh. I was actually on a call with him about 10 days ago, and I was asking him a bunch of questions about that. But he says that's the number one thing people ask him about is his month off, his month of June off.
Yeah, and he writes about it in his blog, so in his newsletter. So he'll share that information with you. So good, thanks for saying that. We do have some helpful resources. If you're not familiar with who we are, Evernest, I'm going to let Matthew tell you a little bit of the story of how we started, but we do have some helpful resources. We have a podcast called 300 to 3000. It's essentially helping property managers grow their business. And so Matthew and I are the host of that podcast. We share any and everything we've learned over the years. Matthew started Evernest with 30 properties. We now manage somewhere around 16,000. So it has been quite the journey, a grind. But so the podcast would probably be very, very helpful. And then we also have a YouTube channel that I kicked off just a couple of months ago. So I'm putting more content on that YouTube channel that is just for property managers. We also have an Evernest channel that I kind of focus all of our client-facing content on. So, all right, and here is what we're going to cover today. So we're going to talk about everything that, we got together, three of us, and we started talking about everything that we could think of. I actually went onto a Facebook group and asked a bunch of questions like, what do you want to hear? Got a lot of great feedback. So here are the things that we're going to be talking about. We're going to just kind of take this in order: sourcing a deal, evaluating a deal, structuring a deal, financing a deal, and integrating a deal. And so we've got some talking points. We've got some questions that we're going to go through, but also if you'll look down and you'll notice there is a Q&A section on on the Zoom webinar. It's the Q&A, not the chat, but the Q&A is going to have, that's where we want you to ask questions. And if you do that, we'll be able to keep a running tab of questions as we go, and we'll make sure we have time to answer those. Anything else you'd want to say, Matthew, right there?
Nope. Looking forward to jumping in.
Yep, we're going to jump in. So, Matthew, why don't you just give people really a brief history of Evernest? I know there's several people in here that don't really know who we are, so why don't you give them the elevator version?
Yeah, for anybody who's listened to our podcast, you probably heard this story because Spencer and I did it as a podcast. It's the first podcast episode we ever did. And then there was a subsequent episode we did about 6 months ago that was kind of bringing the story to date. But Spencer mentioned it. I got into the business back in, 2007, 2008. As many people know, that was when the market crashed. And so I owned about 30 homes that I couldn't sell with some partners. And so we decided, we had this like decision point whether we were going to fire up a property management company or just hand those properties over, and I was going to need to go do something else, and wanted to stay in the real estate business. So decided to start the property management company. Spencer and I go way back. We were both running not competitive, but fairly complementary Homevestors businesses. So there may be some Homevestor franchisees out there. For those of you who don't know, that is the We Buy Ugly Houses people. So he and I were both buying houses. Spencer had a bunch of houses, decided to go get into not-for-profit and or started not-for-profit with another friend of mine. So it's kind of this pretty like closed loop group of people here, Spencer. Now, the more I tell this story, but and when he did that, he gave us some houses to manage. So all of a sudden we were managing like 55 or 60. So that was kind of the seed that got us started. Really just kind of bounced along through the recession. In 2013, I was at a NARPM. Many of y'all know what NARPM is, but I was at a NARPM property management conference and made a decision that I wanted to grow it. What I thought at the time was a regional property management business. There was like a few small regionals. If anybody remembers, One Prop out of Texas was a regional property management business. At the time, they managed somewhere around 5,000 homes. So that was kind of like the biggest thing I'd ever heard of. And so set a goal at a subsequent meeting with a group, with our team, which was 3 people at the time, to grow to 25,000 homes under management by 2025. Didn't know how we were going to get there. We thought it would be very linear. We have found that it is not a very linear path. It's very exponential at the end, and so we're experiencing that today. But just started growing the business. So we managed, when we set that goal, we were managing 250 homes, and so 25,000 was 100 times bigger than that. And Spencer mentioned it today. We manage about 16,000 homes. We're in, I think, 19 different states, over 30 markets. And one of the ways, bringing us right up to this conversation, one of the ways we've grown is we've bought property management companies. My first property management company I bought was actually a third Homevestor franchisee owned a piece of property management company here in Birmingham, and they decided to get out of managing for other people, just wanted to manage their own homes. And so I got the opportunity to buy their business. Now, what I paid for that business was pennies compared to what we pay today, and I'm sure that question will come up. But back at, I guess that was almost 10 years ago. That was just what there was no real market for it, so we didn't really know how to set a price, and so we did that. But that was the first one we did. The business was called Turnkey. We were Golden Key at the time, and so just been growing it, and really excited to share with y'all some of the things that we've learned on how to buy property management companies. So I think it makes sense. If I was sitting on the other end of this, Spencer, I would want to know, why in the world are these guys willing to give away secrets of buying property management company? And so I think that'd probably be a good segue for you or Josh to jump in and show our hand a little bit.
Yeah, I like when we started, we got around at a table and started talking about doing webinars. There's something that's a part of the culture here at Evernest, which is something that especially Matthew and I just love doing, and that's developing our team, developing people professionally, personally. And so we do that in-house with our team through what we call 250K Club every week. And then we started kind of branching out. That's really the idea behind the podcast. We were like, hey, we could probably start a podcast. So we did that in 2020. And then we were like, one of the reasons we love this webinar format is because we get to interact with people. On the podcast, we don't get to interact. And so here we actually get to take questions and share different things and get real live feedback from you all, which is fantastic. And so this is like one of the things that we love doing is helping other property management companies. We think it's good for the industry. And then also we do know that as we do this, we're building relationships, we're building trust. And should the time come for someone to potentially sell their business, then maybe they'll think about Evernest, and we'll get an opportunity to talk to them. And Josh, maybe you want to talk a little bit more about that.
Yeah, I mean, so one of the things that we know is, in the life cycle of a property management company, unless there is a very specific designated succession plan that you have with a family member or with an employee, the way that people exit this business is through a sale. And we estimate that the average life cycle of a property management company is somewhere between 7 and 10 years. And so roughly every 7 to 10 years, people are going to look to kind of move in or move out of the business. And when that time comes to sell, we talk a lot about, being, really happy to talk to people anywhere in the life cycle of their company. People that have, 50 doors or 100 doors. We have bought companies that have 50 or 100 doors, and we've bought, companies all the way up into the thousands of doors. And so wherever you are in that journey, you may be at, 50, 100, 200, 300, and you're wanting to grow to where you're 500, 1,000, 2,000. And so we want to help you in that process. There's a lot of gatekeeping in the industry around a lot of this information, and we want to be a resource. And we hope that through that process, being a trusted resource to you, and putting all our cards on the table and saying, hey, this is how you can go and grow your company through acquisition. One day, it's very likely that you'll come to a place where you are interested in selling. And when that happens, we hope that we've built enough trust with you in this process to where you would give us some opportunity to have that conversation. So a lot of you are probably looking in this webinar to buy. There may be some sellers, though, that are really just interested to see what the thought process is from the buyer's perspective as you're looking to sell. And so if you're looking to sell, or if you are somebody who says, I kind of want to buy, but maybe I would want to sell too, then we can have those conversations offline. Happy to jump on a call. I think McKenna's going to drop my calendar link in there. If you want to have a conversation about what it would look like, what a valuation for your company would be, then I'd be honored to have that conversation with you.
Great commercial, Josh. And selfishly, if you remember, Spencer, when we first started the podcast, we said, wouldn't it be way easier to buy one 3,000 house business than 10 300 house businesses? And look, we're obviously buying mostly 300 house businesses, but part of this was like a selfish thing in the fact that if we can grow you to 3,000 doors, it would be easier for us, and then also make you more money. So that's one of the reasons we're helping you grow your business. So I think we should commercial over. Let's start to get into some of the meat.
And remember, we've already got some questions in the question bar. If you have a question as we're going, just drop it in there and we'll answer those live. We'll hit them live where everybody can see them and run through them. All right, so let's talk. Let's kick it off with sourcing a deal. I mean, this is obviously you got to know where to look, where to find one. I'm imagining, Matthew and Josh, that most property managers who are out there looking or who are thinking about buying property management companies are thinking about it in their local market. Agree? Disagree? And so
Well, that's the easiest way to start.
Yeah, it's definitely the easiest way to start. And so Matthew, this is what you did initially. So talk about some of the ways, like as you were starting out, you were managing 250 properties or whatever. Like, how did you think about finding other property management companies to buy? Where did you look?
Yeah. Well, I think there's two things that have to happen, right? Like, people need to know that you're interested in doing this, right? That you're out there buying property management companies. And then when the time is right, they need to think about you. one of the things that I found is that when people are buying business or selling their business, it's like this information gathering stage happens, and then it happens all at once, very quickly. And what I've found is that there's usually an impetus for pushing people across the finish line. So, the proverbial straw that breaks the camel's back, right? Like if somebody's retiring, maybe somebody gets sick in their life, or maybe they get sick, or maybe their spouse or significant other is frustrated and tired of them continuing to hold on to this business well into their 60s or into their 70s, and they're like, hey, I want to enjoy retirement, and you better quit that business. But whatever it is, it's like there's like this information gathering stage, and then it's kind of like which is like a real long tail, and then it's like an all of a sudden thing has been my experience. So you want to, number one, make sure everybody knows you're out there buying. And number two, and frankly, that's what we're doing right here. Number two is make sure that when they do think about it, they think about you. So I would just look at all these things through that lens, right? One of the reasons we do a podcast is we want to stay out in front of people. The first thing we want to talk about when sourcing a deal is if you've been to any industry events like IMN or NARPM, we're always showing up at that, right? Because what happens is we get in front of everybody on a consistent basis. And because you become familiar with our faces, become familiar with us, and this can happen at the local level too, right? Like attending NARPM lunches on a monthly basis. But what happens is when you're consistently show up, that builds trust. And so when you build trust, that lets people know that that they can have confidence to sell you your business. I did this really early on when we were deciding, we were in Birmingham and said, hey, can we manage 25,000 houses in Birmingham? And the answer is it is possible, but it would be very hard to manage almost all the houses in Birmingham. So we said, well, we're going to have to go to other markets, and Nashville was always on the list. And I don't know if anybody's in here from the Nashville NARPM chapter, but for 3 or 4 years, I would drive on a monthly basis, literally every month, up to the Nashville NARPM chapter lunch and eat lunch, and then maybe do a meeting before or meeting after. But by me doing that very consistently showing up at industry events, and that's kind of number one where we find a lot of deals, is that built trust with the group of people up there. And I built a lot of great relationships, still have a lot of great relationships from there. But I was top of mind, and that's where our first kind of out of market deal came from, was from those relationships at that. It was actually a referral from somebody that I'd consistently connected with. I was
about to say the person wasn't even attending those lunches. This person was a referral to somebody you had built a relationship with at those lunches.
And the proof is that there was actually 2 people from that 2 separate ways it both came to me. And both of those people didn't know that they were referring me, but because I built relationships with them and they knew I was buying, they sold the business to us.
Yeah.
Or they referred the business.
Another way, like if you're obviously in your local market, like how well, outside of the industry events, outside of the NARPM lunches, how well are you getting to know your fellow property managers in your city? Again, like Matthew mentioned, you want them to know that you're in the market. I just interviewed somebody we bought a property management company with, and I asked him, I was like, well, tell me how you heard about Evernest and how this all happened. And well, we kicked Matthew off. And he actually told me, he said, well, I went to lunch with somebody who was running your office here, and we went to lunch, and I got to know him. He was a really nice guy, and it wasn't time that he said, I was just getting into the business. He actually bought his business from his parents. And he said, so I went to lunch with your team leader in this city and had lunch with him, and he was a really nice guy, and we kept in touch. And then, all of a sudden what happened was, so he sold his business 2 years after he bought it, because his partner said, hey, I can't be here anymore. I have to move back to my hometown. Therefore, there's that event that happened, right? It was just like all of a sudden, and he goes, hey, well, I'm not going to run this thing by myself. I need to sell it. who am I going to talk to? And because he had gone to lunch with our team leader several times, he thought, well, Evernest is somebody I want to talk to. And so again, just getting out into the market and letting people know this is what you're doing.
Yeah, I don't think it's terrible to consistently have lunch, even if you don't have a local NARPM chapter with local PMs, and just tell them, hey, do you know anybody that's interested in selling their business? As somebody who owns a business, frankly, it is flattering when somebody asks you the question, would you be interested in selling your business? Because as an entrepreneur or as a founder of a company, you always want one day to build something of value and build something that people are willing to pay money for. And when you do that, it's flattering to know, even if now is not the right time, it's flattering to know that people see the value that you've built. And so don't feel bad about asking that question.
Yeah. What about other forms of marketing? Anything else? I mean, Matthew, of course, we do the podcast. We have this webinar.
Well, you're the marketing guy. What about, and I was wanting Josh to jump in there, but the other thing we've done is very proactive outreach. There's some of our competitors do a lot of emails. We've done a lot of written letters. Hopefully a lot of y'all have gotten those letters. So there's like this proactive outreach. There's also the proactive outreach of picking up the phone and calling people.
Yeah.
Right. Like if you really want to be in a market, or you really want to, buy one of your local friendly competitors, picking up the phone, calling them and having that conversation. So being very proactive, there's like this reactive and then there's this proactive way, and, outreach to PMs and hitting them at the right time. Again, I think looking at it through the lens of, do they know I'm buying? And when they're ready, am I top of mind for them?
Yeah. And I think, okay, go ahead, Josh.
Yeah. So, I mean, really the biggest thing, if somebody were to ask me, and I have a lot of people who do, how are y'all buying as many businesses as you are, and how do you find them? The number one thing is you got to raise your hand. Like that's the biggest thing. I went to an industry event a couple of months ago, and there was a meeting on succession planning and what do you do with your business. And somebody in the audience said, hey, I can't remember if it was my daughter, my son was going to take over. That didn't wind up working out. How can I go about marketing my business to someone to sell it? And it was almost comical, because the response was, raise your hand. I guarantee you, there are 5 to 10 people out of this 200 or 300 people that are here that would buy your business. And that is a huge part of it, is making sure, because if you're not one of those people in that room, when that person says, I want to sell my business, if you're not one of those people raising your hand saying, I would be interested, then you have no opportunity to buy. But people, at the end of the day, sellers need to understand 2 things. One, they need to know, they have to know of you, right? That's pretty straightforward, but they really need to know you. The reason that we have bought the overwhelming majority of the businesses that we've purchased is because people have either directly been able to get to know Matthew over the years, going to these industry events, or they've gotten to know him through mediums like the podcast and through these webinars. And what those things do, being there, showing up, being present, being authentic, it builds trust. And somebody, if they're going to sell their livelihood to you, they need to trust you, and they have to trust that you can execute on the sale. A lot of people can have, great aspirations. We'll get into financing deals in a little bit, but they got to trust that you can, that you're going to treat that transaction the right way. But they also have to trust that you have the ability to execute. And over time, we've been able to show that. And so showing up, building trust, and proving that you can execute are critical components to when it comes time to raise your hand. Because there's a lot of people that might raise their hand and say they want to buy a business, but that seller has to choose one person to sell to. And so that's how you can be in that conversation.
Yeah, I had an interesting conversation with had an interesting conversation with one of the people that we bought from recently, somewhat recently, and within the past 12 months, and asked him how he heard about us. And it's interesting because he said, well, I actually started talking to somebody else, but things kind of started going got a little bit squirrely, and I started thinking, I don't know if they're going to actually perform on this deal. So they didn't have surety, like they weren't really sure that they could close on the deal. And so what he did was he was like, once, I kind of got past that. I saw some marketing material y'all had done. It was really just a recorded video, probably a podcast that Matthew and I had done. And he said, I just thought, oh, well, they're interested in buying property management companies. So again, to Josh's point, to Matthew's point, to everybody's point, like, be active in the market, like let people know you want to do it. And the way we like to do it is just to build trust. And even if these people don't want to sell from us, we want to help them succeed. So our whole mentality is, how can we help people succeed? For some of them, it's going to be buying their company, and for others, it's going to be helping them grow and do something else, which is fine with us as well. All right. Anything else you want to hit on here with sourcing a deal? And I'm looking at the questions just to make sure we don't miss one that's all about.
Yeah, the one thing that we didn't address was there was a question around using a business broker.
Gotcha.
So we have bought businesses from business brokers before. I think it's kind of a love-hate relationship with business brokers, right? Like one of the biggest, so they can either be super helpful or super, wow, I had a hard time getting that out. Create a lot of friction. In the terms of super helpful, like their understanding of the industry and understanding of how to help you through the process, I think is super important. Over and above a business broker, I would say getting a competent mergers and acquisitions attorneys, somebody that's used to doing transactions to help you through the process is super helpful, because we would actually prefer you to have some competent legal advice on the other side, because it makes our job much easier, because they're educating you from a standpoint of a lot of trust, and it makes it easier for us to like move our way through the process. So that's like step one. But going back to the business brokers, I think that if you can find a competent business broker that understands this industry very well, I think they can provide a lot of value. If they are listing a bunch of different businesses, and I know there's some people that actually specialize in being a business broker in this industry, so would lean towards them. If they're representing a bunch of different businesses, there's some things that can be helpful, but I see them as being potentially hurtful as well. So would just be careful with that. Not saying that you couldn't get a really good outcome out of it, but just would be very careful with that. And then on the buy side, so that's on the sell side. On the buy side, I would say, absolutely, because people will list their property management businesses with a broker. You absolutely need to have relationships with brokers. Josh, when he first got here over, I guess, almost 18 months ago, he was having a lot of conversations with brokers, and some of those have yielded fruit over the last 18 months. So definitely would connect with business brokers.
Yeah, no, couldn't agree more with that. I mean, a lot of times business brokers are going to be the gatekeepers. As a buyer, and that's kind of more of the angle that we're looking at it from in this particular webinar. As a buyer, your job is to be a fiduciary of the company, and so you want to be able to get the best deal that you possibly can, right? Super important that you have the ability to do that. And utilizing a business broker, fees can range, pretty wildly, but they can be pretty expensive. And so at the end of the day, a seller is looking for a certain amount of money. They want to maximize what that amount is. A business broker's job is to go in and to package that business together to make it look as delicious as humanly possible. It goes out to the masses, and then they want to get as much money as they can, because the business broker is going to be making a percentage of that sale. And so it can be really important, but you need to understand that if you're going to buy most of the time, a business that is brokered by a business broker, you're going to pay more money. Usually, not always, but usually. And the reason is because that seller, and that money is not going to the seller, right? The delta in what you would have paid for it off market is typically going to go to the broker. Very rarely have we seen, and we've dealt with, I've talked to a lot of brokers. We see brokers that list businesses, and I'm sure you have as well. If you're in the market to buy, you've probably been on the loop nets and the biz buy sells and those websites that list a lot of these small to mid-sized companies. And you might see something that, they're asking 3, 4, sometimes 5 times revenue. And usually those are business brokers that are very detached from the industry. Like Matthew was saying, they may have sold, a gas station and a Taco Bell and a hair salon, all in the last 30 days or 60 days. And so those are people who they don't understand the ins and outs of this specific business. And so it's important that if you go the route on the sell side of going with a business broker, find somebody who is, like Matthew mentioned, accustomed to the business. And on the buying side, it's good to know brokers, but you just need to understand that if you're going to buy a business that's facilitated by a broker, it's probably going to cost you a little bit more money just due to their fees.
All right.
Good stuff. All right, just a quick announcement. Matthew put it in the chat, just so we don't miss questions. They're in the chat, put them over in the Q&A section of the webinar. That would be the best. So we make sure we get them, because as more people comment in the chat, we might lose those. All right, ready to move on?
Let's do it.
All right, this is a big one. We're going to start talking about evaluating deals. Like, how do you know if it's a good deal? So let's kick it off by talking. This is a question that we get all the time. How do you determine an offer price? Matthew, give the concrete answer here.
It's funny because when I first started this out, it was all done on the back of a napkin, so to speak. It was very simple. Curran, me, maybe you, Spencer, we would all have this like conversation and we'd say,
it was bad if you had me in the room talking about offer prices.
Yeah. And we'd say, like, yeah, this is a deal we think we should do. And, and we would kind of like lick our finger and put it in the air and say, well, this is probably what we should pay for it. It has gotten way different. Not that it's super sophisticated today. It involves spreadsheets and a bunch of different levers that you can pull. But the point is, as we walk through this, it is the thing you've got to remember is a deal may be good for you that is not good for us. And I think everybody kind of wants this to fit in a one size fits all box, and it really doesn't, right? Because if you think about it, if I'm in a market and I want to add doors in that market because I may have a lot of capacity in that market, Evernest may be able to pay more money than you because we want to go ahead and build some density in that market and grow that market a little more. If I absolutely want to be in a market, recently we just moved into Texas, so we bought a business that was in all 4 kind of like major metros of Texas. They're all major metros in Texas, but Austin, San Antonio, Dallas, Fort Worth, and Houston. And we were really anxious to do that deal. So, because we really wanted to be in Texas, we weren't in Texas. And so, but there may be a deal that comes across where we have, we're doing really well in that market. We're growing organically, and we don't feel like, we're willing to pay up to get that business. And so we would maybe offer less. So as we're going through how to evaluate a deal, I want you to also realize that your unique flavor or the value you can add is really important here. And I actually was just listening to a private equity podcast, and they were actually talking about, as deals get more efficient, everybody is working with mostly the same information. And we're probably not there yet with this industry, but as this gets more and more competitive, the buying of businesses gets more and more competitive, it'll get more efficient, and everybody will kind of be, using the same information. This has happened in the multifamily world. When people are buying multifamily properties, it's a very efficient business. But what the difference maker is what is your secret sauce? What is the secret sauce that you can add that can help you pay up maybe a little bit more than somebody else to get a deal? And we've got our secret sauces. Now we're not gonna like bear all of that for people, but you need to understand what you're really good at. And when you figure that out, then you can find certain profiles of businesses that can help you help them be more creative when you buy them. So Josh, why don't you take us through evaluating a deal, because you live and breathe this every day.
I do. So there are a couple of things to think about in this. Really want to start with kind of what does the market say, right? Because the most common question that we're asked is, how do you value a company? And so typically what you're going to see is that companies are valued effectively one of two ways. The first is off of a, or at least industry standard, what is referenced is off of a top line revenue number. So property management revenue multiple, and then an EBITDA multiple. So those are in the industry, two most common ways that these businesses are valued. On the EBITDA multiple, EBITDA for those unfamiliar with that, and we'll talk about a couple of things that some of you may be very familiar with, some of you may be unfamiliar with, and so we'll try to provide explanations as we go through the process. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And so it's a profitability metric that most larger businesses use to reveal their profitability, and it's one of the ways that buyers in this industry use to evaluate companies or to provide valuation for companies. So industry, what's happening is we're seeing multiples on average anywhere between as low as less than 1 times top line revenue to as much as 2 times revenue on the top line. EBITDA multiples, I've heard people talk about it as low as 2 to 2.5 times, all the way up to as much as 10 times is what we've heard people say. And so in that, those can be two very different extremes that you're operating in. 1 to 2 times of your revenue is a pretty wide gap. On $1 million company. That's the difference of $1 million. I think that's pretty consequential. But one of the things to point out is that on deals that go as high as 2 times, there are usually going to be an overwhelming amount of restrictions. I wouldn't say overwhelming. There are going to be a significant amount of restrictions that are going to be involved in that. One of those things, and we'll get into this a little bit more, they're going to have a lot of clawbacks. It may come only as a part of a seller finance deal that is carried over a very long term. It may require the seller to roll equity into the company. There could be a number of stipulations that come out of these. But the one thing that I want to point out in this valuation is you can pay what you want to pay. There is no rule that says that you can't pay 2.5, 3 times, 4 times, 5 times a revenue multiple if that's what you wanted to do, but it doesn't mean that it's a good deal. So if you're going and paying, 1 times multiple, a 1.5 times multiple, a 2 times multiple, it doesn't mean that just because you're using a top line number, if you were to find the median of that, a 1.5 time, I don't want you to walk away thinking that if you pay 1.5 times, that's a good deal, because that may be a very poor deal. What is your long-term strategic interest? Why are you buying companies? How many companies do you plan on buying? If it's one purchase that you're going to make, and that's it, then it may not be a big deal for you to pay, a high 1 or even as much as a 2-time multiple. But for the most part, just because you can pay something doesn't mean that it's a good deal. So on average, we're seeing, or kind of the industry, the verbiage that you're going to hear if you go to these ARPA events, people are going to say you're going to get between 1 and 2 times revenue. The reality is the average falls closer to 1. The average falls usually between 1 to 1.5. I would say global averages are probably close to 1.25. And so it really kind of depends on a number of factors that we'll get into in just a moment around what kind of moves that lever. What moves it from a sub 1 times revenue to all the way up to a 2 times revenue? What are some of those things that could happen that would require you to pay that? But before we go there, I want to address the other side of that, which is the EBITDA valuation. So on an EBITDA valuation, you're effectively, it's not exactly the same as your NOI, but you're effectively taking your net income and you're multiplying that out by 2 to 10 times. And a lot of people get confused around this, 2 to 10 times, EBITDA. So let's say that you have 2 different options. One buyer comes in and they offer you 6 times EBITDA. And so that's going to sound on the front end like, okay, I'm getting a little bit more than the median, or I'm paying a little bit more than the median. So that sounds right. Another person is going to offer 1.2 times revenue. So those are going to be things that sound very different. But if it's a 20% margin company, which would be a little bit above average, it's the exact same number. So if you're $1 million company and you're making a 20% margin, so you've got cash flow of $200,000, net profitability coming back into the business, and you're paying 6 times that number for a business, you're paying 1.2 million. That same $1 million business, if you're paying a 1.2 times revenue, you're paying $1.2 million for the business. So a lot of times what you're going to hear, and it can be valuable as you're talking to potential sellers, right? I mean, because there's an element of this that, is important to the seller. What is the thing that they want to hear? It may be that they have always viewed their business and the value of that based off of net profitability. Well, then you can hand them an offer based off of that. Or you can hand them an offer based off of top line revenue. But the truth is, you shouldn't be actually valuing the business, just going in and saying, hey, yeah, I'm going to pay you 1.2 times, or I'm going to pay you 1.5 times. It shouldn't be based off of that. What you should be doing is considering how you can add value into that business. So when you're valuing a business, it's very important that you create your own financial projections, that you get the financial information for that business, and then you pro forma out, you develop a process to see, if I were to take this same portfolio and if I were to lay it over the top of my business, what are some of the efficiencies that I'm going to get? What are some of the gains that I'm going to get by economies of scale as I'm bringing this portfolio on board? It shouldn't just be all about a top line number or an EBITDA number.
Josh, I want to play Troy Aikman here and double click on the EBITDA. My suggestion to you as a buyer is not to try to convert a business that is probably less than $3 million in revenue, maybe less than $5 million in revenue to EBITDA, because what happens is there's also this like owner's discretionary earnings that people get kind of like wrapped around the axle of, where you may have somebody that is running their car through the business, is running trips through the business, and they're trying to pull all this stuff out. And then you get into this like disagreement over whether that should stay in or come out. So all of a sudden, when you start to do EBITDA, and then what I would consider a true EBITDA, like if you had a $1 million business that was running, top line revenue, and, a lot of owners will pay themselves, something de minimis, let's say $50,000. But if that owner got hit by a bus, and we had to get somebody to go run that $1 million business, I'm not going to go out and find somebody at $50,000 to run the business. It's going to be, probably, at least 2 times that, let's say. So now all of a sudden you're getting into the argument over, well, you're underpaying yourself, and so your EBITDA is much higher, and so but it's not actual EBITDA, if that makes sense. So what I say is, we look at it on a revenue multiple, because we know what we can build in underneath from an expense standpoint and what the EBITDA is for us. And then we just, if somebody wants to look at it on whatever their EBITDA multiple is, that is fine. Now, what I will tell you is if we're, and this is Matthew's opinion, so feel free to throw tomatoes at it. But what I would tell you is, if you are selling a business and you are, $1 million to 2 million in revenue, looking at it on a revenue multiple is better for you than looking at it on an EBITDA multiple.
Yeah. And
Spencer, while I was talking, you got everybody stirred up over something. What did you say in the chat channel?
I just asked in the chat.
I mean, nobody was paying attention. I made this like awesome point and nobody was even paying attention to
I'm
me.
sorry. I just asked in the chat if it'd be helpful in one of our webinars if we went through a couple of deals, took out all the confidential information, of course, and just kind of like highlighted, hey, here was our thought process. This is how it worked. Here was how maybe even the negotiation went or something like that.
Yeah. We've actually done that before.
But one thing that's really important is you're looking at a deal. You need to be able to tie all of this to very specific financial outcomes. Just because you can buy a business at 1x revenue doesn't mean that business is a good business to buy. And so if you're going to buy a business, you need to understand what your cost of capital is, because and you need to talk to an accountant. You need to have, if you're strong financially, then you can run these numbers yourself, but you need to understand what your internal rate of return is, your required rate of return. You need to understand what your cost of capital is, because I mean, most corporate function or most corporate finance people will tell you, you don't take on a project, you don't invest in something unless you hit a certain hurdle rate. Because you can go out, you can spend your $1 million and you can go and get, 4% in a T-bill. You can go and get 9% in a spider fund. You can go and invest your money in a vehicle that's going to give you a guaranteed return. When you go and invest it in a business, you need to make sure that it's returning what it should, given the risk that you're taking on. And so you need to know what your weighted average cost of capital is. Your weighted average cost of capital is just effectively the weighted ratio of your cost of debt along with your cost of equity. You need to know what that is. And you shouldn't even remotely consider buying a business that does not at least cover your cost of capital. So you're going to get a return on that business, right? I mean, whatever you spend, $1 million, there's going to be a return on that investment. You need to make sure that return on that investment is significant enough to cover your cost of capital, as well as whatever your required return is. And so you need to be thinking about that as you're walking through these deals, not just thinking about layering over revenue. Because if you're not bringing any incremental or additional value, then you're effectively just buying the business, the revenue and the expenses as they are. But that's before you even take into account, churn, doors that are falling off. You might have a higher expense structure than the people that you're acquiring. They may have understated expenses because they're working from home, where you might have to expand your office to take on that portfolio. So those are all things that you need to be considering as you're looking at a business, because if you don't take those things into account and you have that unexpected expense creep in, then all of a sudden your great idea to grow has not made you more profitable, it's made you less profitable. And Matthew could tell you, I'm sure, many, many stories about the very true fact that bigger is not better. Bigger does not make you more profitable. Oftentimes it can be the opposite is true. So you want to be very, very judicious in how you go about evaluating these deals and making sure that your financial projections are very well in line and that your total cost are going to be more than covered in the process of purchasing your company.
Let's go through you may have said this, Spencer. Let's go through the levers that we think affect valuation the most when we're looking at a deal. Do you want to take us through it, Josh?
Yeah, I'd be happy to. So there are a number of qualitative and quantitative variables that, as we're talking about this 1 to 2 times, and keep in mind that you should be seeing this as an investment vehicle. Again, first and foremost, if you don't have a proper ROI on the purchase of that company, you really need to not look at buying it, regardless of what the multiple is. Like that doesn't matter. So once you've determined what your required rate of return is, and you believe that it's going to be acceptable, then you start looking at the offer band. Because again, if you can pay between 1 and 2 times revenue, again, most deals falling much, much closer to 1 than 2. It's very rare that we're seeing deals traded above 1.5, but it does happen. But the things that will shift that scale back and forth, we look at a couple of things. The first is, why is somebody selling? You need to be really in tune with this, because if it's a fire sale that they're not disclosing, that, hey, I've churned off 20% of my doors in the last 12 months. I just lost my number one person that had all of the real relationships with all of our clients. Those are very concerning things. So you need to understand why it is that somebody's selling, and make sure that it's not something that could potentially be a downside for your business. The other is kind of strategic importance. If you are interested in, this is where it comes to you. If you find a business that you might be looking for, a business that fits your particular profile. You may be somebody who only manages Class A properties. You may be somebody who only manages Class C properties. And so you're looking for a portfolio fit that makes a lot of sense for you. You may be looking for a partner. You may be somebody who's a CEO in your company. You're wanting to grow the company, but you have a weakness. Like maybe you're not great at operations. Maybe you're not great at marketing, sales, whatever they may be. And so you're strategically wanting to align yourself with another company where that leader would want to come on board and grow with you. So what is important to you strategically is something that needs to be considered. And then you need to rate that. So as I'm looking at this as a strategic investment, how would I grade it? Would I grade it as, good, neutral, or bad? If it's, average rents, because in this business, there are some flat fee, there are some no fee property management companies, but generally speaking, most people are charging a % of revenue as their management fee. And so the most important thing to tie you to top line management revenue is the average rent in that portfolio. So you need to understand what the average rent is in your portfolio. So if in your portfolio, let's just take in Nashville, let's say that you have you're in Nashville, your average rents are $1,800 a month, and you're looking at a book of business where their average rents are $1,400 a month. Well, that is naturally going to, it's going to indicate that it's not in alignment with what your portfolio average is, but it also means that if you're buying whatever that management agreement says is the % of revenue you're going to be able to charge, you're going to be able to charge a lower amount of money per unit that you will be for your portfolio. So those things. And then if you look at a business that's $2,100, then you understand, okay, well, I'm getting a little bit more money per unit in this deal than I am in my portfolio. So that might move that lever up a little bit.
Can I jump in here? I think it's also very important to not buy what you're not used to managing. So we've instituted kind of like a lower end. We don't want the average rent to be below X. I think it's $1,200 or something like that, Josh. And we also have a high end because we found that even super high end properties require like special attention. And it's just not that we don't provide a good product, but it's just not what we do, right? Like we want to be in that kind of like middle 80%, kind of middle of the road, traditional SFR management. And so, you may say, well, I'm only going to buy boutique property management firms where their average rent is $3,000. And what I would tell you is send us your name, because we'll send you any deals we come across, because we don't want to manage those. We haven't had success doing that. Or you may say, look, I want to be, right in the middle of workforce housing. I'm fine with my average rent being $800. And send us your name too, because we would be happy to refer deals to you because we just don't want to do that. But I think a lot of this is about really understanding what you're good at and then making sure that you kind of like stay in your lane.
Yeah, and the next thing would be for people, if your goal or if your aim is to grow a regional business or a national business and you're wanting to enter into new markets, you need to take into account whether or not this is going to be a new platform or a new market for you, or if it's going to be a what's referred to as a bolt-on or a tuck-in acquisition for an area that you're already operating in. So we already manage over 1,000 units in a couple of our markets. So if we're looking at in Atlanta, where we manage, I can't remember what the number is, but it's over 1,000 units, and we're looking at a 200 unit acquisition. Those acquisitions provide value to us because we can take those on with very little increase in labor cost. And we all know that in this industry, your cost of labor is going to be, as a percentage of your expenses, one of the highest percentages or one of the highest expenses that you have. So being able to take on a deal in a market that is not going to take a lot of incremental expense, a lot of that top line revenue is going to go directly to your bottom line. So that can make that deal a little bit more valuable. Again, there are a lot of things to take into consideration, but that is one that should be considered. Two of the biggest ones that we look at. So when people talk about red flags, there are two things that we look at that we consider highly critical when we're looking at deals. One is what we refer to as a UPO or units per owner. It is very simply the total amount of units that are managed divided by the total number of unique owners that are represented in that portfolio. And we use the phrase unique owners because we all know property management companies, you may have one owner. It may be Matthew Whitaker is the person that you're managing for, but Matthew has 27 LLCs that all own homes. And so it's important to know how many of those homes there are. And so we have a gauge that we use where between that number being between 1.00, that's an ideal world where every single portfolio where every single client has one home. That is an ideal acquisition for us. Now, for some people, that may be a nightmare. You may not have the capacity to deal with a lot more clients or a lot more owners. The reason that that's ideal for us is because that is the number one thing that de-risks the acquisition. So it is the number one thing that if you're going to look at a correlating value between churn in the long term and your the number of owners, those two things, your UPO and your churn, are going to be highly tied. So we consider anything between 1.00, which, by the way, we've never seen that. I think the lowest we've ever seen is like 1.14. So between 1.00 and 2.0, we consider great, good, no questions asked. We consider anything between 2 and 3 about average. That's what we would expect. No alarm bells, no real concern. The higher it goes into, the more questions we're going to have, but no real concern. Anything over 3.0 is automatically going to raise a red flag. Now, it doesn't mean that we're not going to do the deal, and we've done plenty of deals that have been over 3 in terms of a UPO, but that means that for every owner that you lose, you're losing 3 properties. The average property management company, if you're looking at 150 unit management company, 3 units is a chunk of the deal. That's 2% of the deal, right? So you're going to lose 2% for every owner that churns. That's a big deal. Now, if that number's 1, then it's obviously a much different story. So we look at that. That's a very, very big factor as we look at these. The next is the largest owner percentage. We all know that in these portfolios, there is usually somebody that is going to be an instrumental client to in the portfolio. It's a much bigger deal in companies that have less than 300 units. It's much less of an issue in larger companies that are 500, 800, 1,000 units. And the reason that is because if you have a large owner in a small company, most of the time it's going to make up a much more significant amount of the revenue and much more significant amount of the units than in a larger company. Usually, as you get to a larger company, the idea of being a boutique firm where you're really holding hands all the way through it, and you're dispatching an employee to go to that person's grandson's bar mitzvah or whatever that may be, goes down a lot. And so the risk of that owner being very, very tied to that client goes down. But the largest owner percentage, when we look at it in terms of a risk scale, we look at it on a 0 to 5%, meaning on a 100 unit acquisition, if your largest owner owns 5 units or less, we consider that good. anything between 5 and 10, the largest owner anywhere being from 5 to 10 units in a 100-unit acquisition, we consider about average or okay or acceptable. If the largest owner owns more than 10, let's say, for instance, they own 25, well, that is naturally a huge red flag for an acquirer that's looking at that acquisition, because if they bolt, then you have now just lost 25% of the value or 25% of the units in that acquisition. And that's a really big deal and something that you want to steer clear of. Last couple of things that are things that we pay attention to where we're moving these levers. And keep in mind, all of these things we're talking about, you might start with a baseline of saying, okay, I'm going to come in based on the financials and based on what our return on investment is going to be in this deal. At 1.25 times revenue, we're going to hold it at 1.25 times. And as we start walking through these different issues, the levers are either kind of moving up or they're moving down, depending on the outcome. Another thing that we want to look at is occupancy. So occupancy is important because a lot of times what you have a fear of doing is onboarding what we consider DOA units. You don't want dead on arrival units. That is not a good thing. If you're purchasing 10 units, you want to know that those 10 units are occupied and they're generating revenue. A lot of the times, depends on the company that you're looking at. A lot of times, vacant units are not going to be generating revenue. So you want the units that you're going to be acquiring to be generating revenue already. In that, we consider anything between 80 and 90% acceptable, anything below 80%. And it depends on the time of the year too, right? And the reason it may be that, there's a brokerage firm or there's something else attached to it where they're just waiting to onboard certain units. There can be a lot of different reasons. You got to kind of take that as it comes. But anything over 90% occupied is green flag, no concerns, nothing to think about. Anything between 80 and 90%, you want to ask why it would be, 10 to 20% vacant, but there's usually a good logical reason behind it. Anything less than 80% is a red flag. Hey, we got to dig deep. We got to understand why this is what it is before we move forward, because we don't want to buy a significant chunk of DOA units. Years in business, big deal, big deal. It is what you're doing when you buy these businesses is you're not just buying doors, you're not just buying management agreements, you're not just buying units and revenue, you're buying the relationship that owner has entrenched with their clients over a period of time. And if that period of time is 12 months, we've talked to people have reached out to us and said, hey, I started a company 9 months ago, 6 months ago, a year ago. I'm ready to sell. I'm ready to get out. Well, how sticky is that really? How quickly are those owners, when they realize that you're selling your portfolio, how quickly are those owners out the door and saying, yeah, okay, that sounds great, but I'll go find somebody else. I know you about as well as I know them. So not really a big deal. What you really want is you want that owner, when you go through with that acquisition, to be your largest advocate. You want that person saying, hey, not only did I choose to sell, but I chose to sell to Evernest because. And those are the things that that can help reduce churn, allow those people to stick on, because trust is the name of the game. And so somebody who's been around for a long time, somebody who's been in business for 5+ years, and there's no real kind of hard and fast rule with this. A lot of people have been in the real estate industry for a long time, and then they moved into property management. They have a trustworthy name, they're well known. So there's no hard and fast rule with this, but anything 5 years or greater, we consider in the safe zone. Once you get to 10 years, 20 years, 30 years, you get a lot of very deep trust with those owners, and something really important. I know Matthew, as we've gone through acquisitions over the years, just knowing and being able to trust the seller individually, not just even necessarily they've been around a long time, but just being able to trust the seller is a big deal.
Yeah, I would make sure that you are, and great job running through all those, Josh, but I know that was a lot for everybody to digest, but hopefully that's super helpful. Yeah, absolutely. So I can think of 2 of the 40 deals we've done, 2 sellers stand out that were real problems. And when you don't have the seller working with you post-transaction, and And the first one, I didn't sense there was a problem. The second one, I absolutely sensed there was a problem, and probably should have pulled the plug on it. Would be in a much happier place today if I had, but making sure that they are, that they're kind of working with you, that they're on board with it, that you've built a lot of trust is incredibly important. Let's get to some questions. I know there's a bunch of valuation questions in there. So let's jump through. Let's start at the top. Let's see. For a residential property management company in California, what realistic range are you seeing in the valuation as in terms of EBITDA? Does your company buy the PM business or the book of contracts? We're going to talk about the second answer, but the answer to the first question is we have seen not a ton of valuation differences across states. The valuations have been very consistent across states. So I would say the numbers that Josh used for what we're buying, and we have not bought, so being completely transparent here, we have not bought in California, but don't see, just based on the scuttlebutt around the industry, there's not a big difference between those. So that's that question. I bought a business from a business broker and their fees were 10%. What do you expect a business broker to do to add that value? I think a business broker can absolutely add 10% of value, right? Because number one, maybe kind of like create a layer in between you and the buyer. But the other thing is just like having a clear understanding of the transaction. If you are selling to somebody that you don't know, that you don't trust, a business broker certainly knows how to like go from, the LOI to the contract to the close, and can help hopefully remove some roadblocks. So I do think that business brokers, if you are one on here, we love business brokers, but I do think that they can add value, but I think you need to make sure that you are doing the right, finding the right person that can add a lot of value there. I'm running a company that combines maintenance and construction revenue with their PM company. How do you handle when looking at an offer price? So Brad, this kind of gets into your secret sauce. So, if I was a great operator, a maintenance operator, you may be willing to pay for somebody to either buy the knowledge and the skill set of maintenance. So if I was buying, I saw Deb Newell is on here. If I was buying her business, she's like a maintenance expert. I would probably give her value because I can learn a bunch from that. You may also give that person value if that's part of your strategy. If I didn't have a maintenance business, I probably wouldn't give that person value, right? So that just doesn't make sense to give that person value. So a lot of it depends on your strategy. Again, when you think about like fee management, I know I saw Todd Orshide's on here. He's kind of like a fee expert, he may give people credit for fees that we may not give people credit for if he was buying a business. So a lot of it's just definitely around your strategy and how you look at the world. Does it help with value if you recently passed a DRE audit? So that stands for Department of Real Estate Audit, and all inspections and rent are current with everything in Appfolio. Cheryl, certainly you having your business together. I was going to say crap together, but that your business together is a tremendous value, right? Because when you have all your ducks in a row, it gives the buyer confidence in the numbers, and it gives the buyer when the buyer has confidence, they're willing to pay more for the business. So great question there. Do you evaluate deals based on the company EBITDA or your own company's profit margin? If the company is more profitable than your profit margins, do you buy with an expectation to reduce profit margins? Samuel, great question. The answer is we buy with our profit margins in mind, because the way we think about it is if there's this revenue, what does Evernest look like underneath that revenue? And so there have been times where somebody just runs an insanely lean organization. Maybe an operator is willing to work 100 hours a week to make a huge sum of money. And there is a chance we would implement our structure and actually run it less lean and make less money. So that absolutely could happen, to answer your question. Let's see. Can you compare pricing companies based on a multiple of gross revenues versus profit? I think that actually got answered by Josh earlier. Michael, if it didn't, resurface that question again. Thomas says, have you seen multiples increase with the increase of competition in buying property management companies? The answer is yes for some companies, but they haven't increased, into crazy amounts. They're still fairly, I would told you when I first got in this business, they were very low, but there is, because of, information is more readily available, and this type of exchange is happening all over the place where people are talking about revenues. It's certainly starting to set the price, if that makes sense, for a lot of these companies. Let's see. I'm trying to just stick to valuation metrics. Todd said a company just sold in Jacksonville for 2.1 times revenue with no clawback. Do you think this is indicating a change in a trend or just an outlier? So, Todd, that we kind of know a little bit about that deal. It was it sounds to me like it was bought by somebody that is local. And so I can only imagine that because of their strategy and when it folded into what their business is doing, that made sense for them. I think it is an outlier because I think it is probably a special situation that group is in a certain situation where it makes sense to create more density in that market, because it was a same market sale. But who's to say that, at some point it won't be up to 2.1 times. I mean, certainly there has to be a first. And so I guess there's a possibility that it gets up there, but great question. Do you consider, and this is kind of a similar question to the earlier one, do you consider other income streams when you're using your pricing model? So we have, but again, it has to do with how we look at the world. It needs to be, when we consider that, Michael, it is either recurring, it needs to be recurring revenue or reoccurring. And I know those are very close, but actually different. So recurring revenue would be something like our monthly management fees, right? Like you can count on that every month. That happens on a recurring basis. Reoccurring is a little bit different. And so think about, I would say like maybe leasing fees. We can count on those fairly consistently. In other words, as we get to scale, they kind of normalize on a fairly consistent revenue basis. And so even though we don't know which house is going to turn or which house is going to lease, we can imagine that a house is going to lease if you get to a certain size of scale. And so that's what reoccurring is. And so when we think about it, we only want to buy recurring and reoccurring. So I see brokerages on here. That is not something we would pay for, because unless you can show, and I don't know how in the world you would show this, consistency around that reoccurring brokerage. Yeah, you may say, well, all my fees, I've got all these brokerage dollars for, the last 20 years, but if those brokers go somewhere else, all that money is going to walk out the door. So that's more transactional, and generally we pay less for transactional type revenue, or don't pay for it at all. All right, let's see. Michelle would like to know, where can we best, Josh, maybe where can we best educate ourselves on these financial concepts?
Yeah, so if you're thinking around like things like the weighted cost of capital, and I don't know if that's what you mean, but if that is what you mean, I would get with somebody, find somebody, it may be your CPA. You can find there's a lot of people who provide like fractional CFO services. where you can, hire them out for a couple of hours. I would lean on them. It's not something that the math can get pretty daunting. It depends on the size of your business and the complexity of your capital structure. But the math can get kind of daunting if you're not experienced in it, or you can try some tutorials. I know like Investopedia is a website that you can use. Somebody just put in Ask Chat GPT.
Marketing guy said that.
There you go, marketing guy. So Chat GPT very well may be the way to go. But yeah, I would always defer to check with a professional if you're wanting to figure out what your internal rate of return, your required rate of return, your weighted cost of capital. If you want to understand those things better, I would find somebody, either talk to your CPA or a fractional CFO.
Yeah, there's also, we're huge fans of Profit Coach. Daniel Brooks dropped that in there. I would also say, Josh just hit on this briefly, but actually like Google searching the word, writing those down, like any words you don't understand, writing them down. It's amazing what type of, what you can find on, by Googling it, Investopedia. So it's, these are not like new concepts. And so there's been a lot written about them on the web. Daniel Brooks would like to know ancillary fees. Do you give it the same value as rent? The answer is yes, we do, as long as they're recurring or reoccurring. So hopefully that was helpful. Now that debt service is increasing, are you adjusting your offer band? So just for people who know, Josh talks about cost of capital. So if I use debt to buy something and, debt has gone and mortgages have gone from like 3% to like 6 or 7%, depending on what it is. And so it's doubled, right? So in other words, if I was going to go buy a house, the interest I'm going to pay on that house is double what the interest was, call it 18 months ago. Well, that's also happened in like all like debt facilities, right? So if we went to a bank today, my guess is we would be paying almost twice what we were paying 18 months ago. And so that would actually drive down the cost of businesses. And we haven't seen businesses go down because of debt. I think the probably competition for these deals probably keeps them high, just like in the housing market right now. House prices are staying high because there's not a lot of supply and there's still a ton of demand. And so house prices are staying propped up, even though it costs more to own a house. So hopefully that was helpful there. How does the valuation change when buying the PM business versus book of contracts, especially when the plan is to run all properties through your current infrastructure? April, I actually think these cross over both ways. We're going to talk about how we think about an asset purchase versus buying a big company. But I think that these valuation metrics, whether you're buying the business or buying the assets from the business, I think it's fairly consistent. Justin would like to know, when buying, if acquisition runs on a lesser percentage fee structure or flat fee structure, do you move them over to the fee structure, assuming yours is higher for management fees? And if so, how do you go about doing that? Justin, if you figure out how to do that, you're a magician, and we need to be learning from you. You can imagine that that it is not easy to tell somebody that you're paying them more money. So we do not do that. We actually leave them running on the existing contract. If there's ever a chance where an owner feels like they're going to get a better deal by switching to our contract, we certainly are willing to do that. So, but typically the fees go down when that happens, unfortunately. Let's see. Yes, Cheryl, the recording, we're recording this, everybody. So if for some reason you need to break away, you can catch up on this. So let's see. Let's see, keep going. And do things like resident benefit package that adds to the bottom line help make the management company more desirable for purchase? Absolutely. That's a reoccurring fee that I talked about earlier. reoccurring ancillary fee, so it certainly makes it more desirable. All right, let's see. I think McKenna dropped a couple of questions. Who is my lawyer? Daniel, can you clarify if you want to know who helps us with our transactions? Our lawyer is here in Alabama and only licensed to practice in Alabama. I think he could help you, but happy to make that introduction if it makes sense. Parker would like to know, is there a specific profile that the majority of sellers typically fit? Are they retiring? So yes, for us, they typically fit into 2 buckets. So we have 3 avatars. We have the deal, who we call the deal maker. We have who we call the grower, and we have who we call pops, mom and pops. So we buy the deal maker and mom and pops. And what is unique about them, they're different in age, but they're very similar in terms of what they're wanting to do. They're wanting to sell the business and get out of the industry. So it's very simple. Mom and pops wants to retire, so that's pretty easy. The deal maker is all about, they have another deal that they're chasing and they want to go do that other deal. So maybe they want to get into, maybe they came from a brokerage background and want to go sell houses, or want to go invest in real estate, and the property management company is essentially tying them down. We had somebody that went and opened like a tire store. You can just imagine there's just a bunch of reasons that somebody who is in their 30s and 40s who got into property management and wants to get out and go start essentially a new career or a different career. The grower kind of sits in the middle of that. And the way we think about that person is they're kind of like too old to start a new career. Not that, I'm not saying that they are too old, but they perceive themselves as being too old to start a new career, but they're too young to retire. And that avatar, typically, if they want to sell, wants to continue to stay in the business and operate the business. And there are some people out there that buy those businesses because so they kind of see what's going on and they say, well, I want to be a part of this kind of like industry consolidation. And I'm a grower. Again, I can't retire. I need a job. And so they go and do that as a job and kind of be part of that bigger whole. That is one we have done. So we're not 100% opposed to doing it, but that is it's not what we're looking for. So hopefully that's helpful. But there are some other industry consolidators that absolutely want to find that avatar. Daniel, acquisitions attorney, happy to give you his name. I just don't know how helpful he'll be because he's kind of learned this through us, and so he's very good at what we're doing, but he's not probably gonna he's not gonna make a whole business out of helping all PMs buy businesses. So but happy, maybe he is, maybe you can talk to him and maybe he'd be willing to do it. Yes, Brent, we did talk about that. We talked about how we like to do it based on revenue. And we look at it more on a run rate revenue. So you said trailing 12. So when we buy a business, we think about it on a run rate basis versus a trailing 12 basis. And we do it based on revenue. So and Brent, we did record it. So if you want to go back and listen, hopefully that'll be helpful. So in the essence of time, I would love to, let's move forward and talk about the next section.
Yeah, let's talk about structuring a deal. We're probably not going to get through all of this. We only have 35 minutes left, but we do want to move into structuring a deal because this is, a lot of people have asked about this. So we looked at the different ways you evaluate a company, quantitative, qualitative ways. Let's talk about what are the levers that we or a buyer can use when they're thinking about making that offer? Let's just say they found the company, they're confident in the company, they're ready to buy them. What are the things they need to be thinking about from an offer standpoint? I mean, Matthew, I remember when we were buying our first one out of state. So it was 2016 and we were buying in Nashville. And I remember us sitting around a room thinking about 3 or 4 different ways to make the offer and saying, okay, well, here are some things that we can adjust and let the seller decide which way they wanted to do it. So what are the things they can be thinking about?
Yeah, I think it's really important to understand, like, if you're going to buy a business, you need to find out what is important to that seller. If you are just focused on price, you're missing the thing. Because it's very important. Like the things that we know that are important to seller other than price are what's going to happen with their team. You know, what's going to happen to their portfolio. Like, how are you going to manage? Like, they want to make sure that that you check a lot of these boxes. And as a buyer, you need to know absolutely what's important to the seller. And so, you know, that way you can kind of like structure a deal that meets the seller's needs. And that, again, there are sellers out there, if you can believe this, that aren't interested in top value. There's other things that are more important to them, and that's okay because it's their business and they can, you know, whatever can be important to them. So Josh, why don't you jump in on structuring a deal? Because again, you do this every day.
Yeah, people definitely want to know about like clawbacks, earn out, not all that stuff.
Oh, yeah. So let's go ahead and hit some definitions real quick. Again, a lot of people might be familiar with all of these, but just in case, when we're talking about deals, a couple of things are going to come into play. First is going to be in almost every deal that's done, you're going to have a non-compete and a non-solicitation agreement that's going to come as a part of that deal. The non-compete just means that they will not be in competition with you in the same line of business that you're in. Non-solicitation is that they won't reach out to your acquired employees or clients in that portfolio. Can also be restricted to vendors and all sorts of things. Non-competition, very important though. Average time for a non-compete is 3 or 4 years. It ranges. We've seen them as low as 2 years, as high as 5 years. The average is 3 or 4 years though, just right in the middle. So non-compete, non-solicitations, almost always going to be a part of the deal. And then you've got the type of deal structure, which clawback is the number one thing that people kind of talk about the most. And so I want to go through a couple of ways that people structure deals to alleviate themselves of as much risk as possible. All of these things are effectively the same. They just go by different names. So a clawback is, by way of its definition, is exactly what it sounds like. It's where you go in and you say, all right, I'm going to pay you X amount of money. We'll just say $1 million for your business. But over the course of a period of time, usually is going to be anywhere between 90 days to a year. If you are to lose anyone in that portfolio, you have got to pay me back the amount of money that I've paid you. So again, let's presume a cash deal. Somebody comes in and they pay cash, they pay you $1 million. And let's just say for the sake of conversation, that you've got 100 units. Well, that would be $10,000 a unit that somebody's paying you. And so let's say that 6 months in, you lose an owner that has 8 units. Well, now you are going to be required to pay back to the acquirer $80,000. So that is the definition of a clawback, is actually going back and trying to claw that back. Now, a lot of times these are not cash deals. Matter of fact, the overwhelming majority of the time, these deals are not structured as cash deals. A lot of the times they're structured as a seller finance deal. And the way that they will recover that amount of money is they will take it out of future payments. So in that $1 million deal, you pay somebody $250,000 down potentially, and you finance the balance over 3 years. Those monthly payments are whatever they are, $10,000 or $15,000 a month. If you lose $80,000, then that person is going to take back that amount out of every monthly payout until they have received that clawback amount back. So clawing it back is literally just saying, hey, I was going to give you this, I'm going to take it back now. A different way that people do that is they will escrow the funds. So they'll come in and say, well, okay, well, I think that there's a certain amount of this portfolio that's at risk. So what I'm going to do is I'm going to pay you for $1 million for the business, but I'm only going to give you $500,000 at closing. And then I'm going to escrow the other $500,000 for 90 days, 6 months, a year, whatever that amount is. And so long as either the portfolio is performing, so it's creating the revenue that we projected it will, or so many units stay in the portfolio, or it doesn't fall below a certain threshold, then we will release those escrow funds at X date. And then there's usually going to be some wording in there that says, on like a prorated basis, whatever amount will go back to the buyer and a certain amount will go to the seller if some has fallen out, but it hasn't reached the full escrow threshold. Also, you've got a revenue pass-through. So a way that people will de-risk the acquisition is they'll just do a revenue pass-through. So they'll go in and say, instead of paying you up front, what I'm going to do is I'm just going to give you whatever revenues I receive in property management fees and in leasing fees and XYZ, whatever's agreed upon. I'm going to just pass through those revenues to you for a period of time. Or they may say, so if the deal was going to be a 1 times revenue or 1.2 times revenue, they may say, well, I'm going to pass through the revenue for that for 12 months or 14 months. Or they may say, I'm going to pass through half of the revenue over 24 months or 28 months or 30 months. So a revenue pass through is a way that it's used. Another is an earnout. And so this is usually kind of seen as a way to compromise. If somebody is saying, okay, my business is worth $3 million, but as a buyer, you feel like it's only worth $2 million, then you may go in and say, all right, well, what I'm going to do is I'm going to pay you $2 million. And if this portfolio performs the way that, you were saying it's going to, or that I believe that it can, or whatever that winds up being, then you will earn an amount greater than the purchase price if XYZ conditions are met. So there are a lot of different ways to structure the deal, but those are typically the terms that you're going to hear are going to be revolved around that. So when it comes to deal structures, kind of bringing it back, there are 2 different types of acquisitions. You're either going to have an entity purchase or you're going to have an asset purchase. An entity purchase means that you're going in and you're buying the entire corporation. So XYZ Property Management LLC, you're going to go in and you're buying XYZ Property Management LLC and everything that it has. So in that situation, XYZ Property Management LLC is the owner of the management agreements they have. They're the owner of their intellectual property, so on and so forth. And so you're going to buy the entire entity. But when you do that, you're buying all of the assets, but you're also buying all of the liabilities, not just future liabilities, but any prior liabilities. And so it's a different process to go through buying an entity versus what is far more common in the property management industry, which is an asset purchase. In an asset purchase, you are not buying the property management or XYZ Property Management LLC. You're buying all of the management agreements and whatever other assets are agreed upon in the sale. Usually in most property management companies, there are not going to be tangible assets. There can be, if you want to include office furniture and equipment and computers and that sort of thing. Occasionally, there may be a maintenance truck that's going to be purchased, but most of the time, they are intangible assets. They're going to be the management agreements. They're going to be.
We're actually going to sell Spencer when we sell this business. Spencer's going to go with it. So if anybody wants to buy Evernest, you'll get Spencer as an asset.
I've been looking for a way out of this place. That's perfect.
No, you're going with the place. That's my point.
Oh, with it. Oh, well, as long as you're not with it, that's fine.
So if anybody wants to buy Evernest and or Spencer, please.
You get Spencer. It's like BOGO, buy one, get one.
So in an asset purchase, it's usually going to be property management agreement that you're buying along with your intellectual property and a lot of your trade name, trademark, logo, website, phone numbers, those sorts of things are going to come with the acquisition. And so you're either going to have one of those two. It's either going to be an entity purchase or an asset purchase. And then within the entity or the asset purchase, they're going to be structured usually one of two ways. It's either going to be an all cash deal, where you're going to come in and you're going to say, okay, so long as nothing, is materially changed from the time that we sign a letter of intent to the time of closing. At closing, you're going to get X amount of dollar in cash, and then the transaction's complete. The other way, which is probably the far more common way, is that you have a deal that's structured as seller financing, where usually industry standard is going to be 25% down and then the balance paid over 3 years. Now, the balance can be paid over 3 years, either monthly, it can be paid quarterly, it can be paid annually in annual installments. But a lot of these deals are seller financed, where the buyer is going to pay a certain amount up front and then they're going to owner finance or seller finance the majority over a period of time. That period of time is really dependent on your ability to pay it back. What is your cash flow position going to be? Are you going to be able to service the debt on that over a shorter period of time? You could pay it back over 18 months. You could pay it back over 36 months. And how long does that seller want to carry the risk of that? So is the seller going to want to wait to have themselves paid back over 4 years, 5 years? It's always, as a buyer, it's in your best interest to extend that for as long of a period of time as possible. So if you can extend it for 5 years, 10 years, then you may want to do that. But usually buyers are not going to be open to extending that beyond 3 years. Another thing that's become far more common in the industry with a couple of larger players is the opportunity to roll equity into the business. So you could approach somebody and say, hey, you've got $1 million business. So instead of giving you $250,000 down and then financing the balance over 3 years, what if we rolled that $250,000 down into equity in my business? So now you're moving from being an acquirer, which is, selling that potential owner on the idea of selling you a business, to becoming someone who's pitching the idea of your business growing value over a period of time, and then they would be able to reap the value of an exit at a later date. So that's usually the way that these deals are going to be structured, either all cash, seller financed, or a portion rolled into equity of the acquiring company.
So one of the things I want to jump in here is when somebody explains to me, essentially structuring the deal and presenting an offer, I think the big word here is all about risk. As a buyer, you're buying the future cash flow of the business, right? Like I wouldn't buy something unless I expected to get some sort of future cash flow. And that's what you're buying, is that future cash flow. And so when I think about risk, I think about, well, what is the risk of me not getting that future cash flow, right? And so am I assuming the risk of not getting that future cash flow, or are you as the seller assuming some of the risk of me not getting that cash flow? And so when I think about, let's talk about like owner finance. Like owner finance is the seller basically assuming some risk, right? Because there is a risk of you not paying them back. If you put it in like an attrition clause or a clawback, they're assuming the risk of owners leaving. So the potential should be there for them to make more money. If you're putting all the risk on me as the buyer, then it would make sense that I'm going to discount the value because I'm assuming some of the risk, right? I need to essentially, you're not going to get as much money and I need to pay myself for that risk. And so, so if somebody says, hey, I want an all cash offer, then I would pay less for that business. So hopefully that makes sense. And so the way we think about that is we're constantly moving those levers. And when we make an offer, we kind of say, well, what is important to you, seller? And if it's more important to have a big headline number, then we're more than happy to do that. But we may want to put some sort of clawback, attrition clause. We may want to put, ask them to sell to seller finance all or a portion of it. So that's how we think about the offer. Another way to explain the asset sale versus stock purchase is, since everybody here is in the house, and I thought Josh did a great job of explaining this, but just think about it. If I bought a house And I could buy it two ways. I could buy a house that's in an LLC. I could buy the LLC that owns the house. And so that would be the stock purchase. I would essentially buy the stock of the LLC that owns that house. And by virtue of the fact that I bought the company, I get the house. Or I could buy the house out of the LLC and put it into my LLC, or put it into Matthew Whitaker name, and then own the asset. And so that's the way. What we typically do is, in that scenario, buy the house out of the LLC. And as Josh said, then the seller can kind of like wind down the LLC. We can take the important things, which are typically the management agreements, out of it. And then we, kind of go on, integrate that business. All right, let's hit some.
Yeah, you want to knock
questions?
out some more questions?
Let's do it.
All right, start at the top. We got 12.
Well, let's talk about structuring the deal. Let's go and hit deal structure.
Okay, gotcha.
Well, this is kind of deal structure. How often do y'all burn time because the P&L doesn't match what promised on the front end, and how have y'all better streamline your verification process as those results? We don't, I think the P&L is typically what we expect it to be, because everybody knows we're going to look at it. So we don't burn a lot of time, on saying, oh, it's $1 million business, and then we get it and it's like a $700,000 business. Josh, anything you'd add there? That just doesn't really happen all that often.
No, it really doesn't. I mean, and most of that is vetted out in due diligence. So in something we just unfortunately won't have the time to get into today is, a lot of what you're doing on the front end is you're asking for a lot of information to get to a place where you're comfortable making an offer. But after the offer is made, there's a window of time between an offer, which is usually presented initially as a letter of intent, and then the actual closing. So between that letter of intent and closing, you walk through more due diligence, where you're trying to tie together everything that you were presented, because usually what you're getting is just Excel spreadsheets of P&Ls. And so what we spend time doing is making sure that everything was on the P&L can be tied back to property management software, to bank accounts, to trust accounts, to make sure that all of that information was valid. And as long as it was, then everything should be pretty well matched up.
All right, let's move on. For the sake of time, we have 15 minutes, and we want to make sure we're staying within the time and try to at least hit all these things. So financing a deal, I'll probably take this, because this typically is my area of responsibility. So obviously, if you have cash, buying a business is going to make it worth it, right? Like you either are independently wealthy, or have money from savings, or maybe your 401k. I don't know how people have cash, but the other way you might have cash is through the business producing a bunch of cash, right? Like your business is starting, as you start to have some success, it starts to create a bunch of cash. You have that cash sitting in the entity, you can go pay for it. Like obviously that's possible. But let's talk about like debt and then raising capital. So let's go through a few things. First of all, is when we first started buying businesses, we used the cash flow, what we call cash flow from operations. So I am not independently wealthy. Spencer is, he just does it for the love of the game. I have to work for a living, and so I'm out hustling. And so using the cash flow from the business was how we financed it. And then we would also use bank debt. When I first started getting bank debt, because there's not a lot of assets here. So just think, if I quit paying the bank, what are they going to come do? Like break into our office and rip open our filing cabinet and grab a management agreement. It just doesn't sound like something that they're going to want to do. So banks struggle to finance these deals. So what our bank did is said, well, we want to go get an SBA guarantee. And I don't know the exact numbers. I think the SBA will guarantee for them like 75% of the loan. So if let's say I'm buying $1 million business and they expect me to put 25% down, that's $250,000. I may go get a loan for $750,000. And then the SBA will actually guarantee like 75% of that loan, or maybe it's 80%. I don't know exactly, but and there's so some things about doing that. There are actually banks out there that can do SBA underwriting in-house. I would lean towards using one of those banks if you can. But there's also these things called SBA packagers. I think that's probably the right word. If you have a bank that's not used to dealing with the SBA, don't necessarily listen to them that they are, going to know what they're doing. These SBA packagers know what the SBA is looking for, and they collect a fee. They are worth paying the money if you need to get the SBA package to get it, because the SBA wants it like a certain way. And if you don't give it to them that way, then this process just takes forever. Now, listen, the SBA takes forever, period. So you just need to be very patient. You need to have a very patient seller. And so I would say, you probably need 60 to 90 days to close an SBA deal. And that's with 60 being like the bare minimum, 90 being more realistic. And that's with somebody that knows what they're doing. I think that during COVID, SBA got overwhelmed. So I haven't bought a business using some sort of SBA backed financing since COVID. You can imagine that COVID, all of us were, hitting the SBA up for dollars. And you can imagine post that, they're probably still trying to dig out from the hole that was created by the pandemic. But you absolutely can use an SBA. If you have a great relationship with a bank, it is possible that they'll finance one or two of these deals. We did get the bank finally to finance one or two of them, but you're just not going to go very far because, again, there's no tangible thing for them to come get with if you ever stop paying. The second way I would talk about or think about is seller finance or owner finance. What a great way. If the seller trusts you, then it is a great way for them to make more money and for you to use essentially their equity and pay, convert that into debt and pay them out over time. We have paid some really great interest rates, especially when interest rates were non-existent. We've paid some really high double-digit interest rates to owners. And so if they trust you, then, earning a double-digit interest rates when the cost of capital, a T-bill was 1% or 0% or negative is a pretty good deal. So if they don't need all the money, one of the great things about especially people that are retiring from this business, they've typically owned this business 20 to 25 years. They've made some really good money, probably paid off their house. They probably own some rental property that cash flows. They just don't, if you gave them all the money, they're not going to throw it all in the stock market. They just don't trust the stock market. But if they may trust you and be willing to finance you as an entrepreneur because they kind of, one of the benefits I had is I think a lot of people saw themselves in me. And as I was just getting started, and so they wanted to be helpful and also make money while being helpful. Another way that I've financed deals, so you kind of like run out of bank. Like at some point, the bank shuts you off. If you want to read a great story about a bank shutting somebody down, Shoe Dog's a great book to read. They kicked him out of the bank. When the bank hopefully doesn't kick you out, but when they say, "Hey, Matthew, we're not lending you any more money," you're going to have to go to friends and family to borrow money and or sell equity in the business to finance some of these deals. If you can get friends and family to loan you the money, some of them prefer to do that, right? Like, hey, you may have a rich uncle or a rich, cousin that is willing to loan you $1 million and you can pay them, some percentage rate on that and pay them over 3 to 5 years. Or maybe you just pay them interest because they don't want the money, or they want the money, but they don't want the principal paid back. And you can, over 2 to 3 years, at some point you can essentially season this thing long enough to where the bank might refinance you out. But point being, if you can get debt from friends and family, that's a great way to go. If you need to sell equity to friends and family, that's a way you can do it. The big challenge with that is like setting a valuation of the business. We've talked about valuations here, so maybe you could kind of like come up with an agreeable valuation. But if you're selling portions of your business, you got to have a valuation. We've actually utilized something called a convertible note. I'm not going to go too deep into this, but it basically doesn't set a valuation, but sets, if you ever go raise institutional capital, it was set valuation at that point. So, friends and family, the thing I would caution you, there has been nothing in this business that has led to more sleepless nights than taking money from family. So I would just caution you, if you're going to do this, just know what you're getting into and make sure that you treat their money better than your money. The fourth thing there is family office. So a family office is like a rich person that may be in your market. Maybe they sold a business a few years ago, or maybe it's a rich family that's always been rich. You can go get money from them. They're always looking to invest, especially in your market, into businesses that are, they're like, when I think about Birmingham, there's like a few families in Birmingham that are really proud of Birmingham and want to invest in Birmingham businesses. And so they may invest in you. Now you're going to have to start getting to some scale, and also have to show them like some meaningful valuation, future valuation, to get paid back. So they're not going to do it out of the good family office isn't going to do it out of the goodness of their heart. Usually your friends and family will do it out of the goodness of your heart. One thing I would also tell you about friends and family, when you take their money, you tell them that I only want you to give me money that you are willing to lose. That was kind of like the saving grace. Is all my friends and family, I told them, hey, and every single one of them almost made them repeat it back to me. You are, if I lose this money, I'm still going to be your dad, or I'm still going to be your mom, I'm still going to be your brother, I'm still going to be your neighbor and friend. So just know that. And then the last thing is just more institutional capital. So we've raised from so thus far what's called institutional debt. So these are kind of like debt funds that have helped us buy businesses. Again, you're going to have to get north of probably 10 million in revenue and 2 million in EBITDA to do this. But there are some debt funds out there that will help you continue to grow your business as you get up there. And then, of course, we've heard about this in our industry. There's private equity and there's venture capital, which are a little bit different. Private equity is more like traditional, looking at the business from a profitability standpoint. Venture capital is kind of what you hear the software industry that are like banking on big total addressable markets, big things happening, big billions of dollar businesses. And so there at some point, again, at about 10 million and 2 million in EBITDA, you can start to get into an area where they would be interested in financing and funding your business. But that was really quick. I think we're going to miss probably the most important thing. Maybe we should do a follow-up webinar on integrating the businesses, but that is the financing portion of this, and we only have 6 minutes left.
You want to try to blow through some questions real quick? I know we're not going to get to integration.
Yep. How do you communicate acquisition and change to the owners from the company you're buying to ensure retention? So great question. We want the seller to communicate first, because that's where all the trust is. And then we're going to follow that almost like click them. They send out communication, this through email. Then we send out communication. We have a series of 3 emails that go out that are communicating to the new owners. And then we also try to proactively call each owner and have a conversation with them. For someone who does not have a full broker's license, how would you overcome buyer objections? And how would you join NARPM as a non-broker? I don't think NARPM delineates between being a broker or not, so I don't think that should be a gating item for you. For someone who does not have a full broker's license, how would you overcome buyer objections? I don't think you would. I don't think that they should care. I didn't have a broker's license when I first started this business, so it shouldn't matter. Does scaling third-party management create more opportunities for direct asset ownership? Or is that part of the Evernest strategy? I ask because I'm evaluating third-party management for quicker scale to afford some corporate overhead and also to put myself in front of opportunities for acquisitions? The answer to that, Andrew, is yes. It absolutely does. In fact, we are basically creating that side of our business right now. So we've hired a chief investment officer and a chief real estate officer that's going to be focused on asset ownership. The only thing I would say is make sure that you don't try to chase two rabbits here, because growing a third-party property management company will take a lot of your focus. And if you're trying to do both, that could be a problem. But I know that there's some people that have like boutique brokerages that own a lot of the assets that they manage, and they use third-party management to help scale, like you're talking about. How do you work out managing in multiple markets? Is the key having great PM at each location? Absolutely. At the end of the day, where our best leaders are is exactly where our business is growing. Matthew, you've got to really focus on getting the right butts in the seats. I know that's like an overused term, but I'm telling you, where our leaders are and where people are competent and capable leaders they're just crushing it. And it's just shocking. Let's see. If you're just starting out, would you buy an existing business over starting one? You don't know. I think it depends. I think you learn a lot, Paul, if by going through the motions. So I've done all the things, all the jobs, and I think the probably 5 or 6 years that I was growing to 250 homes is invaluable. And I think I think that we're better operators because I did all that hard work. But there is this kind of like buy and build strategy. I just think you certainly can kind of like cash flow faster, but you're giving up something, I think. Do you also buy portfolios containing small multifamily properties in addition to single family homes? Yes, Rob, we buy, the way we think about it is that anything that doesn't have on-site management, while there is things like budgeting and some other differences, we think of those as being run, a lot closer to SFR or SFH as it does to like large multifamily without on-site. So we absolutely buy those. What is the ideal size of the PM company you prefer to buy in Dallas? That is very specific. I mean unit number size. So this is across everything, including Dallas. So we have a Dallas Fort Worth office, and when we buy in a place where we already are, there is no minimum unit size. So we would buy, 25 homes, let's say. To move to a new market, let's say we were not in Dallas, we would say typically we want 250 to 300 homes. But for this specific person in Dallas, we would buy pretty much any portfolio. I heard that having a 1-to-1 owner to property ratio is ideal, as you don't have one owner who holds a large percentage of the business in their hands. What about management agreement commitment? Most of my property owners are on a month-to-month agreement, so just wondering if that's a bad thing. The good news, Cheryl, is ours are on a month-to-month agreement, and so that is okay. Now, I don't know how that would affect valuation with others, but it certainly doesn't affect it with us, because that's part of the way we operate is on that month-to-month. We try to earn our business, every month. If I was starting again, would I find a local business broker specializing? How would I find a local business owner specializing in PM businesses? Those business brokers are just like real estate agents. They are the easiest people to find in your city. I would just Google search business brokers in whatever city, Nick, and then roll with it. California, a question about California. Is it easier to expand within a state? Yes, because you're used to the laws. Expanding to another state, you're going to get a change in laws. And then the last question is, where can we find business brokers familiar with property management? I think a couple of names got dropped into the chat channel. So, but NARPM is a great place to find that. All right, we are up against time. One of the things I hate is when people go over. So it is 5 o'clock. I hope everybody has an awesome day. Any last thoughts, Spencer or Josh, before we go?
Yeah, I would just say if there's anybody here and you are like, you came to listen to how we buy property management companies, maybe you're thinking about buying property management companies, but maybe there's a couple people here that want to sell or thinking about selling. You can book a confidential discovery call with Josh. We just dropped it into the chat, so feel free to do that. He'll make room for you on his calendar and he'll be happy to talk to you. That's it. Thanks, everybody, for being here. We appreciate it. Thanks for your time.
Bye, everybody.
Everybody.